What up, HyperChange? Welcome to another episode of the podcast. Today we've got an up and coming 21-year-old investing guru on the show, Henry. Henry, welcome to HyperChange. How are you doing today?
I'm good. Thanks for having me, Gally. Super excited to be here.
So, Henry, for those who don't know, has been making a name for himself in the online investing community by publishing research on a company called Upstart. Actually, one of my old Patreon subscribers introduced me to your work, and I started looking into it, and I was like, wow, this kid is like going places. Some of the best research on Upstart out there. You've engaged the company, you're working with them to help tell their story. So really just doing it and crushing it in the real world, even though you're only 21. So huge congrats to that. Um, and I guess I want to start out by making this fun and as exciting as possible for people listening. So what is the thesis on Upstart? Like, give us like the banger, like 30-second, 60-second elevator pitch. Why is Upstart so fascinating? Why is it the stock that you spend so much of your time on?
Yeah, for sure. So Upstart goes public in 2021. And rates are near zero. They have only one product, an unsecured personal loan, and they have a capital base, meaning the people that are funding the loans, that is entirely at will. So the people that are funding it can come and go as they please. There's no commitment. Fast forward and their AI is in its infancy. This is 2021. ChatGPT launches in 2022, and the whole AI narrative doesn't really start to pick up and progress until then. So fast forward to today, we have multiple products. We have a funding base that is over 65% in committed form, so it's much more durable. You have AI models that have rapidly progressed. And you have a company that is structurally stronger and ready to rock in a tougher macro because of these AI wins. Yet at the same time, a lot of short sellers are sort of holding on to the company that Upstart was in 2022 and 2021, and they're not understanding that this is an entirely different company that's really plugged all of the holes in its business model leading up to today.
And so in simple terms, like what does Upstart do? What's their business?
Yeah, so that's the funny question, right? The CNBC momentum trader goes on there. They're like, "What does Upstart do?" He's like,
That
"Oh, I
is the
can't hear you.
question.
You're breaking up, right?" So it's a tough business to understand, just because there's no direct comp in fintech. But Upstart is an AI lending marketplace, meaning they use AI and machine learning to better underwrite credit by being more comprehensive and by bringing sort of the data science world to predicting credit outcomes. And so what they do is they've developed a software for credit underwriting that they sell to banks, credit unions, and institutions as an API in a sense, right? And so they get fees and from licensing this software to those institutions, and then also for each loan that's originated, they get a fee for that as well. So when things are going well, and this is part of the business, a part of the business model they had to fix, they're actually not funding and holding the credit risk themselves. It's a technology company that's applying AI to credit. And maybe it'll be helpful. I don't know if I go through sort of what happened in 2021 and 2022 to paint a clearer picture on how they've changed.
Yeah, go for it. And I thought it was interesting though. So they basically have this technology to figure out whether people are worthy to lend to better than the status quo. They're selling that out. It's a 7.5 billion company right now. How big can this get for like just to make it sound exciting? Like, are we looking at $100 billion company potentially? Like, do you foresee like a ton of upside in this industry? Like, are they in the early stages of commercializing this like AI credit underwriting, or is that kind of already happened in the lending market?
Yeah, no, the lending market is almost completely untouched. I think we're in the second inning of what may be the next biggest industry on Wall Street. I think it has trillion dollar market cap potential. So if we just sort of rewind to 2021 and 2022, let me just paint a picture maybe quickly for your listeners.
Yeah,
In 2021, Upstart goes public with one product, an unsecured personal loan, which is by nature the riskiest type of lending product because there's no collateral. So when times get rough, if you sort of imagine a borrower's payment funnel, well, the loan that doesn't have any collateral is going to be at the bottom of that. They're going to pay off their car loan first because, they don't want the bank to take their car. So that's the only product they have. Their AI is in its infancy. It hasn't progressed to the way it is today. And their capital base is all at will. So when that creates a max volatile business, cyclical business. And so when the macro is risk on, rates are near zero, everybody starts funding these upstart loans that have high returns and the stock price soars. Now in 2022, the Fed starts to raise rates. That immediately is bad for lending because it pushes more people outside of the approval box by bringing up APRs. And Upstart's capital sort of disappears because the Fed also clearly telegraphs that, hey, we're going to keep raising rates, and so lenders no longer want to fund loans at all. So now Upstart's in a position where their number one product is cyclical and on the back end of, being unfavorable, and their entire capital base has disappeared, and their AI models are not as sophisticated enough as they'd like them to be. So that creates a euphoric downturn in the stock price. Add on to that during this time, Upstart is saying to themselves, well, we can't just not originate loans because number one, we need revenue. And number two, because we need to keep gathering all this data for a data moat. And if we don't originate loans, we can't do that. So what they do is they start to fund and hold these loans on their own balance sheet, which freaks Wall Street out, especially with the recession narrative. And Wall Street reprices the stock as a high-flying tech company to more of a financial with credit risk, with sluggish growth. And that really causes the share price to go, from a hot IPO at $20 up to 400, and then to early 2023 down all the way to $12. And so it created a max volatile business. Yes. But now Upstart's taken four measurable steps to combat that. Number one, they've rapidly progressed their AI, which we can talk about later. Number two, their funding base, which was all at will, is now 65% committed, meaning if the president of the United States decides to launch tariffs on everybody, lending partners can't just say, hey, we're not going to fund loans anymore. Like they're stuck and they're committed in these relationships over long periods of time, which gives Upstart more revenue durability. Three, they have many more products now, including auto loans and HELOC loans, which are actually counter-cyclical to their original unsecured personal loan. When times get tough, people aren't going to take out unsecured personal loans, but they may borrow against their house in a HELOC loan. So there's more credit book diversification there. And they also sold off most of the vintages that they held on their balance sheet in 2022. And none of those vintages during that time actually lost principal. So while credit investors of Upstart may not have reached the desired returns that they wanted, nobody lost money. So this idea that Upstart was just originating easy loans is really not well founded. And then one of the biggest revelations that's just come to be in Q1 is Upstart's traditionally competed in sort of the non-prime, subprime area of credit. So people that have a thin credit history, people you'd expect to be mispriced by the system. But now what they've done is they've taken this digital first tech process driven by AI, and they said, okay, hey, we're going to still serve these non-prime customers, but we're also going to take this technology and apply it to customers of all creditworthiness, including prime. So they've rapidly expanded with a program called T Prime into prime borrowers. Think of that as a FICO over 720. And that's diversified their credit book too. And so it's made the company as a whole much stronger, much more resilient, much more durable. Yes, they'll still be sensitive to the macro and what the Fed does with rates, but to a much, much, much lesser degree than what happened in 2021 and 2022.
And what's Upstart's like secret sauce that makes them different? Like you say, it's all about like data. So what kind of new data are they bringing in the equation to get something that's better than the FICO score? Because I feel like
Yeah.
a lot of people talk about disrupting the FICO score, but I'm curious, like, what are they actually doing to really back that up? That's providing so much value that, that's kind of their secret sauce. That's why they're worth so much.
So today, Upstart has 91 million data points. That is growing at an exponential curve. So next year, you can expect that to definitely increase, probably near 200 million. But to understand this, we have to go back to sort of FICO versus Upstart, right? FICO is static underwriting, meaning they use 8 to 15 characteristics to arrive at a composite score that they assign each borrower. Your credit history, your credit usage, things like that. And so Upstart will take a more comprehensive view, so they'll use more variables. In their early days, they found that where somebody went to school was actually more predictive of whether or not they would pay back a loan than the FICO score, right? So if somebody, went to Yale and they're in finance, right? Well, that job, if there were to be a recession, is probably going to be back in high demand, right? That they're a high income earner, they can go get a job quicker than somebody else. So that'd be one instance. But really, it comes down to the data science of it. So this is an example that they used at AI Day, and I think it's really a really good example. So if you have two borrowers, borrower A and borrower B, and they're going for a 36-month loan, and say the aggregate default rate, or the default probability for both borrowers over the course of that loan is 10%, right? Well, what if borrower A's default risk is front loaded Meaning, what if they're more likely to default in month 5 of the loan, whereas borrower B is more likely to default in month 30 of the loan? Well, that would call for very drastically different interest rates because borrower A, if they default in month 5, well, there's a huge risk of a greater loss of principal. Whereas if borrower B is defaulting in month 30, yes, it's a default, but they paid back more of the principal. So those should be two very different APRs. But what FICO will do is it will look at that and say, hey, well, over time, their aggregate default rate is 10%. And so they'll price those borrowers the same, which is a huge problem because borrower A now is underpaying for credit because they actually have more upfront default risk than the market and than is profound for borrower B. And borrower B doesn't have as much credit risk upfront as borrower A. Upstart will individually assess the likelihood of default and even repayment risk for each individual month of a loan, which is revolutionary. It's called dynamic underwriting. So their underwriting is constantly learning, adapting, and evolving, which helps them get better rates for their customers. Now, if you offer better rates because your AI is more predictive and accurate as to whether or not people are going to pay back their loans, well, a better rate results in increased conversion, meaning more people will take out your loans. Increased conversion results in more revenue. It also results in more customer loyalty. And that is the cycle of growth that fuels Upstart. Now, how do they do it? Well, their AI is constantly getting better. So a prime example, I mean, and there's several examples of this. I would encourage people to listen to Paul Gu at AI Day, but there's a really key part of it called the PTCC, the parallel timing curve calibration. Got to make sure I get that right. But what this does is it'll essentially, for a new model, Upstart's on model 23 right now. So model 22 would be the past version. Model 23 will go in and look at all loans that are currently outstanding on that Upstart originated. Let's say, for sake of example, they're in month 18 of a 36-month loan. Well, Model 23 will make predictions as to what would have happened for the 18 months that are already realized, that are already in the books and done. And then Upstart will cross-reference and say, okay, how did this model do relative to what actually happened? But then what the new model will do is it will make predictions for default risk and repayment risk for the next 6 months of that loan that's still in progress. And it'll see how accurate it is. And Upstart will get this data over the course of just a few months. And allows them to understand new models and launch new models quicker than the rest of the industry because traditionally speaking, lending is a zero-sum game. Lenders, to know if their model was effective, will just say, okay, well, we have to wait the 3 years to see if they pay us back or not. Upstart is using AI to sort of not only back test and look at how would it have done for predicting the first 18 months, but then forecasting it for the future and then implementing that and iterating those models and launching new models over time. So just in 2024, they were on model 18, and then model 19 came a little midway into the year. Now they're already on model 23. So the velocity or the rate of change by which their AI is accelerating is also accelerating. And so that is sort of the data moat that they have going on with their predictive power. And then this is really where it gets crazy. And it's similar to Tesla with the data moat for, robotaxis. Is Upstart wants all of this data on one foundational model for credit, meaning they want to get to a place where all of these predictions for any credit product, HELOC, auto, personal loan, purchase mortgage, is all on one model, and that is the foundation model for credit. So a consumer can go on to the Upstart's website, check their rate instantly for any product, and know that they have the best rate, the best process, no documents uploaded, and there's no need to shop around for a better offer. And so they want to combine all those products into one model, which can then cross-reference so many different intricacies, and it would just be immensely powerful. So that is the end game, and that's why I think, if it works, we're talking trillions of dollars in potential market cap.
And love it. And so you were actually just at the AI day, and I'm curious, every company's trying to say they're an AI company right now, but would you say that Upstart really is in the way that they're able to leverage the technology to be kind of a truly disruptive company in their industry? I like the end vision that you said of like this foundational models that offers you a better loan on everything. So it seems like they're going to be they're like number one company in the space, like going for it
Yeah.
all.
That's correct. And people say, well, when you say that, like, well, why aren't they farther along the line? And I think the answer, in my opinion, is simply because it's so early. This is the number one company in the space, and they have a little over 100 banks and credit union partners. It's so early. We saw a taste of what it could be post-COVID with the interest rates near zero. But now it's starting to become more and more prevalent. And so if you go to AI Day, right? Well, how do we know Upstart is an AI company? Well, they first started using the word AI in 2015 to describe their business, although they were using AI prior. They just didn't feel like they were using it enough to describe themselves as that. So this has always been a machine learning and AI company, and that's been a big part of their history. And so a lot of their early days really revolved around risk separation and a better process. So risk separation just means, okay, look, these banks think that this group of borrowers is bad. When we look at this group of borrowers that the banks call bad, how can we find which ones are actually really not that bad? That's risk separation. And that's Upstart's cream of the crop. Like they're very, very good at that. And then what they brought to those customers was also, hey, like our AI is so good at understanding your credit profile that if you want to apply for a loan, like you don't even have to upload us your W-2. Because if we know that you're going to Cornell University and you're in finance, well, then it makes a lot of sense that you're probably making 80 grand a year. So just reducing the latency and the clogginess, I guess, of applying to get a loan, and that increases conversion. And then when you increase conversion, you get more data. And then when you get more data, you unlock new AI and machine learning features. And that improves the accuracy of your loans. So Upstart's been using AI for a very long time. And they over 90% of their loans today are fully automated, meaning there's no human intervention, and you can get your loan or your funds in just minutes.
One thing that I'm always looking at is the owner, operator, founder. And when we were
Mhm.
talking before, you mentioned that they have, I believe, this trifecta and they have the same. So can you talk a little bit about the leadership of Upstart? And you mentioned a little bit about how they've always kind of been the AI pioneer in the space, but curious about, and how you think about that through like the investor lens. Like what kind of equity does the CEO own? Like what's his incentives? Like, is that a big part of your process? And how does that relate to the Upstart?
Yeah, so this is a founder-led company. They were very underfunded as a private company, meaning that, they didn't have as much capital as they would have liked. So it's not past them to get by with a lot less than what they need. It's co-founded by Dave Gerard, who's the current CEO. He worked at Apple and he also worked at Google, and he ended up developing what became Google Cloud. And
Wow.
essentially, he's an older founder, and he really had this itch for better pricing credit near the end of his time at Google. And from listening to a lot of interviews, it seemed like a lot of his peers didn't believe that he had what it took to found a great company and to lead a company to success. And so that was a lot of his motivation. And they go public, right? He still owns to this day about 11 to 12% of the entire company. He's had share sales of 105B, and a few in the 200s or 300s in 2021. But largely speaking, he has kept his core position. And it's founder led. He's done a lot of interviews. And really, if you listen to a lot of his verbiage, if you will, in 2022 and 2023, even when times got tough, he was constantly communicating where the business could go in the future. Now Dave is just one of the co-founders. Anna Councilman is another. She left Google to join Dave to found this. She recently left. I believe she was more of operations, kind of the quiet founder, but did have a large pivotal impact. And then there's this third founder that's also really impactful called Paul Gu. He was a Peter Thiel fellow. He was
Oh,
actually
wow.
Paul Gu was actually so young that when he co-founded Upstart with Dave Gerard, that Dave had to convince his parents to let him do this endeavor. And so Paul wrote the initial models for Upstart back in like 2012, 2013, when they were still trying to figure out what exactly it is they wanted to do, with the formal business pivot really coming in 2014, 2015. And Gu has been at the company since. He has not left. He is Chief Technology Officer today. He did a segment during Upstart's AI Day talking a lot about the technology. And the big thing that he brings is all the data science you could want. And what Upstart is doing right now is they're taking a bunch of big data science problems and they're solving one each year. So just a quick example, in 2023, business has been decimated, right? We talked a little bit about risk separation, identifying which borrowers aren't as bad as the banks say they are. But then how do you quantify what the macro is doing to those borrowers? In other words, maybe this is a good borrower, but the macro is just so tough right now that the good borrower is being adversely impacted. How do we quantify that? Because otherwise, you're just kind of flying blind. Well, in 2023, Upstart developed the Upstart Macro Index, which quantifies the impact that the macro economy is having on their borrower base. So it goes from a scale of 0 to basically infinity, and 1.0 is average. So anything above 1.0 suggests that the macro economy is having a negative impact on credit performance. As it stands today, the Upstart Macro Index is about 1.47, meaning that defaults on Upstart powered loans are 47% higher than the long run average as a result of the macro. In 2021, UMI was sitting around zero point 0.6 to zero point 0.7. So you can see how that business scaled very, very quickly. And then in 2022 and 2023, you started to get to the 1.7s and the 1.8s, which is a big macro impact on the borrower. But they solved the problem of quantifying the macro on the borrower in 2023, which gives them more insight and perspective into how to run the business, how to price credit, and how to price their loans. So it is a really big deal, and that was a big change that they solved in 2023. And they're looking to solve a big problem like that almost every year. And nobody else has come close to doing anything like that. That's a really hard data science problem.
So, I guess to sum it up and kind of tie it into the valuation and stuff, when would you say like the earnings are going to hit for Upstart? Like in that run, they had one quarter, it looks like in 2021 when they made 60 million in operating income, so a couple hundred million run rate. But then their business shrunk a lot and now it's kind of growing again. So, when do you see, and now they're kind of break even, like when do you think we're going to have a massive earnings explosion that will drive upside? Um, like, is there a big moment with like a product launch or something that's going to drive that?
Yeah, so we talked about 2021 to 2022, and then 2023 to 2024, they were losing money. But what you'll notice is during that time, their R&D expenses did not decrease. They stayed the same. So they never cut their tech investments or their R&D for profitability. Even though this is a company that's heavily profitable and their number one goal is really profitability. So right now they're at break even. They will, I think, be profitable this year. They've guided for at least break even in GAAP profits. But the structure of the business is set up right now where their fixed cost basis is very lean. So that's not going to grow materially. So all they need to do to achieve positive EPS is grow the top line. They're doing that right now with those model improvements that we've talked about. Now, I think they'll be heavily profitable in 2026, even if rates stay the same, just because of the model wins that they're experiencing. Now, but if the Fed drops rates 100 basis points, this could get absolutely crazy, euphoric, and that would totally accelerate their earnings power. Now, I'll just mention one quick thing on this too, Gally, is I, as well as another person, have sort of counted the reviews of Upstart loans off a website called Trustpilot.
Oh, I wanted to ask you about this. This is really,
Yes.
really cool, unique data you have. So keep going. Sorry,
So,
I'm excited.
no, yeah. So I went back and hand counted the daily review totals for Upstart loans all the way back to 2022. And it's created this master data set that we've then taken and we've created moving averages for. How many reviews on this day, right? What's the moving average look like? So over the past 90 days for Upstart, for example, they're experiencing more and more Trustpilot reviews. The trend is up, which therefore suggests you would think that revenue is doing well too. Now, it would be totally just to be inherently skeptical of that and say, well, how do we know that that's predictive of their actual earnings? Well, I've developed a proprietary model that I call Upstart IQ that uses these Trustpilot review trends as well as a few other metrics to come at an estimate of what I think revenue can be. It's been right 3 times out of 3 for the last 3 quarters and predicting massive revenue beats. And
Love
it
it.
says it says that Q2 is also going to be a revenue beat as well this quarter. And so everything, the business is firing on all cylinders, and I think their general market underestimates the improvements. Number one, that their AI has made. Number two, that their capital base has really improved. Right now that you're more funded, it's a lot easier to grow originations. And then the other two big parts of the thesis are the diversified borrower group, which unlocks more funding to credit. It makes the credit book a lot more stable. And then also more products that are just totally accretive to the top line. And when I was at AI Day, I had a chance to ask CEO Dave Gerard a question during the event, and he said that purchase mortgage is going to be coming maybe this year, but that we should expect a new product launch every year. And with a stable fixed cost base, with AI automating the entire process, each one of these products is entirely accretive to the bottom line and the top line. And so I think, they've been building the base of what's to come for the past few years, and we're going to just start experiencing the fruits of that labor. So I think profitable, at least break even is what they've guided for this year. Should definitely be profitable in 2026. And if you start talking about the Fed dropping rates, I think it'll get crazy real fast.
And we're looking at about a $76 stock right now. What is your like 2030 like long-term price target? Like you think we can be $1,000 stock? Like what's your kind of bull case scenario here?
Yeah, so for the past year, my price target has been $150. I've had that since shares were roughly $30. And we almost
What's
got
your
there.
average price, by the way, also, if you don't mind me asking?
My average price, I have a massive position at $35 a share is the average price
Is
in
this
the main
like your
account
biggest holding?
by far.
Okay, yeah, yeah.
Yeah,
Yeah. I
I
kind of
know.
knew that, but I wanted to get hear it on record for the podcast.
No, yeah, for sure. Because I know some people come on here and they talk the talk about whatever stock they're invested in, but they don't, they're not backing it up. Not only am I financially invested in Upstart, but to a degree, my reputation is put on this company. And I talk a lot about it every single day, and I'm not afraid to be wrong. And, I've been around for a long time. So I remember the dark days of 2023 with the short seller attacks when the price was
I like how you've
$15.
you've been around for a long time, but you're only 21.
Yeah, I know, right? But it's taken up so much of my time. I didn't think it would get to be this time consuming, but I've just fallen in love with it. But to get back to your question, $150 is my baseline target. I think that's what shares will be approaching, not advice, of course, but I think that's where shares will be soon, is my guess. Now, if you want to start talking 2030, 2035, I think this easily has over $1,000 share potential. Like I said earlier, I think if what there's a lot of execution risk from now until then, and there's a lot of unknowns with the macro that could impact that. But if they can truly become the tech company that has created a foundational model for credit that underwrites credit for the entire global economy that you can access by going onto their app at a click, right? At the best rate, the best process, totally automated. I think that has trillions of dollars in market potential. And at AI Day, their investor event, they said that the total credit originated each year is about $25 trillion. If you were to assume a 5% take rate on that, which is roughly in line with Upstart's take rates, that'd be $1 trillion. So $1 trillion in revenue potential is what the company is forecasting. And people will say, "Oh, but credit, right? With AI, it'll get bogged down. It'll be static. There'll just be a price taker." It's not true. FICO is a price taker because they have very similar scoring as all the other banks and credit unions. The dynamic underwriting and the AI edge allows Upstart to not be a price taker, but they can use their take rate as sort of a growth lever, how they want. So higher margins, and I think they'll capture a lot of the market pretty quickly.
Wow. And I'm just curious, is this like your first insurance play, or how did you get so into the insurance? Because you're saying all these terms and lingo that's like way over my head. I'm not into the insurance industry that much, but um, how did you get to like nerding out on this so much? And do you really think you know this more than Wall Street analysts in the market?
Yeah, so well, it's more of credit than insurance, but it's still like
Okay,
fintech, data
great.
science. Yeah, yeah. No, but so essentially, when I heard Dave Gerard say that it's possible to price millions of Americans more accurately by using AI, I was immediately hooked. This idea that credit is not fairly priced and that every American is overpaying for credit because some credit bureau is lazy in how they're underwriting you infatuated me. And it really sent me down a path of just learning everything there is to know about this business, the potential, the regulatory scene, anything you can imagine. And yes, to answer your question, I think right now I am probably, and I really don't mean to sound arrogant or anything like that, but I think I'm probably the most in the know analyst covering Upstart. And, two interviews with Upstart CFO, one of which was in the summer of last year when I had a very, very small following. I think proves that. The CFO has given me a lot of praise and even said similar things. And then also, I was invited by the company to go to their investor event, which was maybe 40 to 50 people in total. It was me, the leadership team, a few other upstarters, and analysts. And what I noticed is as I sat watching this event live, the analysts around me were not paying attention. I won't name drop because I'm saving that for when the stock explodes, hopefully. But the analysts were on their phones, texting on Bloomberg, not paying attention. And then we get to the Q&A portion of the event, and they start asking questions that have already been answered. And, there's a lot of skepticism about these analysts already. And I, didn't entirely believe that maybe they really just didn't know what they were talking about. I thought maybe they just didn't care. But, then I go to AI Day and I saw it with my own eyes that they did not care and that they were not paying as much attention to it as somebody like me or even the retail investor community for Upstart now, which is pushing 1,000 members. And so I think the analysts are behind. They're clinging on to 2021 and 2022 narratives. They are not paying attention because the groundwork that Upstart has laid, what we've already went over, took place in 2023 and 2024 and early 2025 and is now just starting to show up in the financials. So I think once that happens, they'll start to pay more attention. But analysts follow numbers, they follow sentiment, they follow stock prices. They don't always follow, the fundamental transformation of a business.
Gotcha. Well, mad respect for covering the company. I think you're onto something big here. I personally don't own any stock, but I am very impressed by the research you put together here, and I love the vision. I think they're going for something big, and it has huge potential. So where can people find you? Like,
Yeah, so I'm primarily on X at Henry Invests. That's where I post a lot of my research. But I'm also doing this unique venture where I'm managing my own money in sort of a hedge fund type style, which I call Maple Tree Capital. So
April?
that's at Maple Tree Cap on X. And so I think the reason that a lot of my audience, follows me is because I'm not here to hide anything. I say what I believe. I don't delete anything. I've been wrong publicly several times. And Maple Tree Capital is like a public audit of everything that I do. So my growth fund, Jonah Gold, is up over 400% since January of 2023, since I launched it. And since 2024, Q1, I've written a shareholder letter. These are normally 10 to 15 pages of exactly what I did during the quarter, exactly what, the moves that I made, the research that I did, the companies that I looked at, and also at the end of those letters, I set personal goals for myself to achieve by the end of the next quarter. And so my journey as an investor is very public. I don't really hide in the shadows. And so I think a lot of people appreciate that. But yes, my channels are primarily the Henry Invest account on X. And then, if you want to look at my returns and a little bit more of my investment philosophy outside of Upstart, that's on Maple Tree Capital.
Nice. Well, I think you got huge potential. Really excited to watch you keep crushing it and following Upstart. So thanks for joining the show.
Thanks for having me.